Alrighty, Bill, good to have you on.
Thanks
Just for
for
some
having
quick,
me.
yeah, just for some quick background for the audience. I've read that you have helped over 6,000 real estate investors get real estate loans to grow their portfolio faster. Can you please shed some light on how you've been helping real estate investors and typically what loan programs make the most sense for them?
Yeah, so we're the number one consumer direct non-QM lender in the country. So what happened in 22 is interest rates went up, LLPAs on conventional loans went up, and it actually made it where DSCR loans or non-QM loans were cheaper for real estate investors than showing their tax returns and their W-2s and all that good stuff. So we really found this niche to be able to help real estate investors. We have several money sources. We're backed by private equity funds, insurance funds, hedge funds, regional banks, wealth management funds, where they have an appetite to invest in real estate and they're willing to provide you the capital. So we sell all of our loans to, like I said, private equity funds, et cetera. And it's an alternative way to finance rather than conventional loans. So most people are stuck doing conventional loans, showing all their tax returns, W-2s, all their list of rental properties that they have to go over one by one, or they're doing hard money, which is much more expensive. So think about this alternative financing kind of between traditional financing and hard money. It's kind of an in-betweener, if you will.
Okay. So if we start with the basics here, for someone who hasn't used a DSCR loan before, what kind of problems are they typically facing with traditional loans or funding options?
Yeah, I think there's so many problems that could happen with a investment buying real estate. The rental income can come in low. So when the appraiser goes out there to assess the rental comps, that's on a form called 1007. And the realtor may or may not know the area that well. And the rent could sometimes come in low, but you know the rent is going to rent for the payment or higher, and you know that the cash flow is going to be there. So there's a lot of roadblocks that can occur. And so what happens is a lot of real estate investors say, I'm not going to show tax returns. I'm not going to worry about a DSCR loan. I'm just going to get hard money, finance it with points and higher interest rate because it still makes sense to me. So that's why so many real estate investors go with hard money. But if they knew and could partner with a lender that really understands DSCR loans and to get those points, fees, and interest rates way down further than a hard money loan without all the red tape and without all the hassle, then they would easily choose a DSCR loan.
Makes sense. When they're doing more of the conventional financing, what type of hurdles do you think that they're typically facing?
So when you're doing a conventional loan, they're going to look at your debt to income ratio on your primary residence. They're going to look at your credit report. They're going to look at your assets. And then they're also going to look at that individual property that you're purchasing. So there's a lot of moving parts, a lot of paperwork, and a lot of things that can go awry. And, there's additional penalties from the GSEs, from Fannie and Freddie for investment properties. They see them as higher risk. So there's additional points and fees that are associated with conventional investment property loans.
Got it. A lot of people hear DSCR loan and they think like that sounds really expensive, right? Can you clear that up? Like how do rates and fees actually compare in the market?
So right now you could get a DSCR loan in the sixes. You can get a DSCR loan almost the same as a conventional loan right now. Sure, you're going to pay some points if you're in the sixes. Most DSCRs are going in the sevens, low eights right now. So very comparable to what conventional financing is. So it's actually a lot more competitive than most people think. Of course, you're in the driver's seat on how you want to structure the deal. So you're going to look at it and you're going to say, how long am I going to own this piece of property? So like Warren Buffett says, invest in real estate and never sell. Buy and hold forever is the saying. It's a lot of different people have said that. Right now, the key is to buy assets. And how can you buy as many assets as possible without being limited? So that's really what DSCR loans are is, you're in the driver's seat. You want to pay this interest rate or that interest rate. You want to pay points or no points. You want to attach a prepayment penalty to it because you're not going to sell. So you might as well attach a prepayment penalty to it and get a lower rate. Or you may not want a prepayment penalty, but you're going to pay a higher rate and you're going to pay higher fees. So really it's up to you to do those numbers. The math doesn't lie. So it's just making sure that you get connected with a financial expert that's going to run those numbers for you so you can make a clean, easy decision based on actual information.
Makes sense. How does Griffin Funding make this accessible without cutting any corners?
I think what sets us apart is we're really going to dig into and anticipate the issues and the roadblocks. So if you're on an airplane and all of a sudden it just starts going crazy with turbulence, everybody's going to freak out. If the captain would have simply come on and said, hey, we've got some turbulence ahead, buckle your seatbelt up, go get a cocktail, it's all good, don't worry, we'll be through this turbulence in 10 minutes, everybody's completely fine and relaxed. So we try to prepare the real estate investor for all of the pitfalls, the roadblocks, everything that's going to occur throughout the process. So one of the hardest things is that we don't know what that rental income is going to come in at. We're at the mercy of the appraiser, who is a third party. We don't have a relationship with them. That's the new rules. You don't have a relationship with them. And and they may or may not know the market. And it's a roll of the dice of who you end up getting. And it's very important with a DSCR loan that the property cash flows. So if the total payment is $3,000 a month, principal, interest, taxes, and insurance, that the total rent, gross rent, is $3,000 or more. If not, you need to have a backup plan in place and a backup plan in place. And that's what we provide.
Do you want to shed a little bit more light around what those like backup plans really entail?
Yeah, so all my loan officers who are financial experts, they're trained personally by me, are taught to ensure that we have a plan A, a plan B, and a plan C, a backup plan and a backup plan. So since the 1007 is out of our control, we want to package that file up perfectly for underwriting. But the 1007 piece, the appraisal piece, is out of our control. The value of the property could not come in where we need it to be. The value of the rents could not come in where we need it to be. But you still believe that that's a great asset to invest in. And you don't want to lose your financing. You don't want to get bumped out of escrow and lose the deal. So at that point, we're going to present ahead of time a plan B, which we want everybody to be okay with plan B and plan C. Even the worst case scenario needs to make sense in order to do that deal. So plan B would be, hey, the rents came in a little low or the property came in a little low. So you're going to need to put an additional 5 to 10% down. So instead of putting the typical 20% down on a DSCR loan, you might have to put 25 or 30% down, making the LTV 75 or 70%. The interest rate's still going to be about the same. So it's just whether or not they want to part with that additional capital and put that additional down payment in, if that makes financial sense for their plan or their group of investors that they're investing with. If that doesn't make sense, then plan C is a very unique product that we have in the marketplace, and it's called a DSCR asset hybrid loan. So the other day, for example, we had a client come to us and plan A and plan B were not working. And he really wanted to get out of an 11% hard money loan. And it wasn't up to the 1007. This is an existing property. He has an existing lease. So we're able to go off that existing lease. And the existing lease is $4,200 a month. He's at 11%. He wants to get out of the hard money. We were able to offer him 7.75% to get him out of that 11%. But the total payment, because it was a $580,000 loan, the total payment was somewhere around $5,500. And so he was about $1,300 short. So what we did is we said, hey, look, I know you don't want to come in with money. And he was at 75% loan to value. So he would have had to come in with an additional 5% just to do a rate and term refinance. He's not pulling any cash out. He's just going from 11% to 7 and some change. Yeah. And he's saving a few $100s a month, almost $1,000 a month. And so what we did is we said, hey, do you have any assets that are liquid that are sitting around? Obviously, you don't want to put more money into this property. He said, yeah, I've got plenty of assets. And we said, well, look, if we can set aside $75,000 for every $25,000 in assets that they have, and they don't have to pledge these assets. We just need to know that they have a rainy day fund if something were to go wrong. And for every $25,000 that they have, we can take $416.66 to be exact, and add that to the rents. So for an example, now we were able to pull $75,000, so roughly $1,300. We could add in this asset hybrid DSCR loan to the $4,200 and make up his rent and get his rents up to the $5,500 by using his assets as income. It's called an asset depletion product. And so we were able to use this hybrid loan and get it to where it needs to be. Now, obviously, that's not the best interest rate on a DSCR loan, 7.75. Today is whatever today is, June of 2025. So obviously these rates can change. Hopefully they'll go down in the future, but that's not the greatest rate. He didn't get in the low 7s or high 6s because he had to use this hybrid program. So obviously there's a little bit more risk with that. The money sources, the investors are going to price that accordingly. So it's just all math. And if the math makes sense to get out of an 11%, you're going to go ahead and move forward with that plan C, and we present ABC to everybody. Whereas our competitors, they only usually have one set of guidelines or one investor that they sell the loans to, one set of rates. And if you get denied, there's no backup plan or backup plan. And that's just one of the things that sets us apart from delivering on every single deal to every investor that comes to us.
Amazing. I enjoyed hearing that real story. Obviously, like Griffin Funding is not new to this. Do you have any other standout client stories of people who used a DSCR loan to fuel their portfolio? Like what type of property were they buying? What did some of those other numbers look like?
Yeah, so we have this cool concept or tool that we teach clients, and it's called the property multiplier effect. In other words, you've heard of the concept of the velocity of money. Economies crash when money stops moving. And so if you can continue to create velocity with money, that's when you can get wealthy. So essentially what we do is we teach people to buy 2 properties their first year, and they put, $400,000 property, put 20% down. So they're roughly coming up with $160,000. They can do that through syndication. Part of it can be gift. gift. Part of it can be out of their IRA, doing a self-directed IRA. There's a lot of different ways they can come up with this down payment of 80K and 80K for 160K. And so essentially you look at real estate over the last 90 years, on average, it's appreciated 5 to 7% over the last 90 years of the ups and the downs. And so if you take that appreciation, which is a gift, by the way, you can look at how is these two properties going to appreciate over a 4-year period, where I can then extract my down payments back out, and then I can go out and buy 4 properties and turn those 2 properties into 4 properties. So we teach them how to do this over a 4, 7, 12-year period, where in 12 years they can have 18 properties. So it's amazing how many clients come to us that want to get out of hard money, like my first example. They want to get out of the 11%. And hard money is short-term financing too. He wanted a 30-year fixed so he could hold this for 30 plus years. And then B, the people that come to us that want to start building wealth, buying multiple properties, don't want to be restricted by conventional financing on multiple properties. And they have a tool, a way to grow their portfolio very, very quickly. And the third piece is they've already got a portfolio. That's like ideal client number 3 is they come to us and they go, hey, Bill, or hey, Guy, or hey, Charlie, whoever our best loan officers are. We have 6 properties, my wife and I, and we've got tons of equity. They're like 40%, 50% equity. And it's just sitting there. And we want to leverage this equity and buy more properties. So we'll do a cash out refinance on those 6 properties, and we call it a 6-pack. And we'll do another 6-pack for them. And we'll do another 6 loans at once on another 6 properties. And within, a month, we'll turn their 6 property portfolio into a 12 property portfolio by leveraging that cash out and still keeping their rents where the rents are cash flowing. And it's amazing what we're doing for people with that. So we get a lot of people coming back year after year after year looking for long-term real estate investing financing for buy and hold properties all over the country. So we can do DSCR loans in all 50 states plus DC. So we help people all over the place.
Love it. For someone listening to this and saying, I love this, but I just don't have the cash up front, what are the financial options available to help get them started?
So with that plan C I talked about before, the asset hybrid DSCR, that also applies to a 15% down option. Okay. So a lot of times if you put 15% down, just depending on the area of the country with real estate right now is like reheating a bowl of pasta in the microwave. One side's going to be ice cold and the other side's going to be blazing hot. So that's what real estate is. It's a regional game. So you may find something that cash flows if you put 15% down, but in most areas of the country, it's not going to work. So that's where you need that asset depletion calculation to add to the rents to be able to get in the door with that deal. So we're one of the only lenders in the country that allows only 15% down, but it's got to make sense. It's got to make financial sense for the client. There has to be some sort of compensating factor in order for that to make sense for them and for us as the lender. The other thing you can do too is if you're new is you can join a local real estate investing club, or you can get involved in networking, or you can raise money. You can do what's called a syndication or pooling money together from investors. You can form an LLC and will allow you to finance a property in the LLC, and both the loan docs, the recording, the deed, everything will be in the LLC. It's all going to be in the LLC. And so for privacy purposes, this is great too. But we do need one person to personally guarantee the loan. So they're signing the loan documents with their social security number. It won't show on their credit, but it will show on public record that their LLC owns the property. And what we ask is that half the money come from that person that signs. So in other words, if the minimum payment is 20%, you need to come up with 10% on your own. And the other 10% can come from your group of real estate investors that you've pooled or syndicated money through. So that's a little bit of a hack in order to get started. Of course, if you own a primary residence and you bought your primary residence in 2019 or 2020 or 2021, you're one of those lucky few that actually got to buy a property before rates went way up and before home values went way up, and you have a ton of equity. The average homeowner right now has $300,000 in equity. And what you can do is you don't need to touch your first mortgage with that low locked in rate. Some of you out there have locked in a rate of 2.25% for 30-year fixed or 2.99 for 30-year fixed. We actually, during that time, locked a few people in at 1.75, believe it or not. And so you don't want to touch that. And it rarely makes financial sense to touch it. Maybe one out of 100 people. So you can do what's called a home equity line of credit. And it's a second mortgage, sits behind the first. You don't have to touch your first. And then that way you can extract the cash and you could use that cash to invest in real estate. So one of my big mentors started telling me way back when, invest in assets. Inflation is coming. The best way to hedge against inflation is buy assets, buy assets, buy assets. And so that's all we try to teach is let's buy as many assets as we can for you. And let's make sure it makes financial sense. And let's grow your real estate portfolio.
Couple more questions for you. Let's talk about the decision maker in the household, the spouse or the business partner. What's the best way someone can explain this kind of investment to get them on board?
Well, that's what we just asked them back. So based on our conversation right now, how are you going to explain it to your spouse? And we have them explain it back to us, or we do a conversation like this, or we point them to a YouTube video, or we record it on Zoom and we have the spouse listen to it to make sure it makes financial sense. But we just give them a little bit of homework. We give them a little, it could be a little spreadsheet we give them. It could be a little email. It could be some of the charts, graphs, cool stuff that we do with our different calculators. And we'll just give them a calculator at the end of the day. And all you got to tell your spouse is the numbers don't lie. The math makes sense or it doesn't make sense. So there's so many complicated things that go into it. Am I going to pay tax? Is the new OBBB bill going to pass? And am I going to get 100% bonus depreciation? Do I have to do a cost segregation report? I mean, that's something kind of cool to talk about too, is like when you invest in real estate, you're really looking at 3 to 4 key write-offs or benefits of real estate. The first one is appreciation. You can't count on appreciation. Appreciation is a gift. If you get it, great. The number 2 and the most powerful tax deduction on the planet is depreciation. So normally, if the big, beautiful bill doesn't pass, you just simply take the property that you're buying and you figure out which portion is the land and which portion is the actual building, the improvement, right? And so let's just say you're buying a $200,000 property and you figure out a $400,000 property and you figure out 275,000 of it is the improvement. So you simply can divide that 275,000 by 27 and a half years. And every year you get to write that off on your taxes. Now, if you're a real estate professional or not, there's some rules around that. You got to talk to your CPA. But the cool thing is you can write that off on your taxes every single year. What the big, beautiful bill does with 100% bonus depreciation, that's why so many people bought jets back in the day, because jet, you can depreciate it all year one. Same thing with real estate. So you can do what's called a cost segregation study. You can do it yourself or you can hire somebody to do it for you. It says of the $275,000, that is the improvement. How much of it is eligible? Do I break it off in the cost segregation? How much is eligible for the 100% immediate depreciation? And then how much do I have to leave in there for the next 27 and a half years? So what's really cool is most likely that 100K of it is immediately depreciated on that year's tax returns against your income. And you immediately get a $100,000 tax break for buying a real estate investment property this year. Like that's going to be huge. Like we expect our DSCR loans to quadruple if the big, beautiful bill passes with 100% bonus depreciation. I mean, that benefit is just absolutely amazing and incredible, right? Of course, number 3 is cash flow. So appreciation is number 1. Number 2 is depreciation. Number 3 is cash flow, earning that cash flow every single month. And that cash flow continues to grow over time. And the 4th, of course, is the additional write-offs that you can write off on an investment property that you can't write off on a primary residence. So like, for example, you can't write off a certain amount of the taxes and insurance. There's caps in different cities and states. You can't write off HOA fees. You can't write off what I call TIMR. So we can put a little acronym together. So taxes, insurance, management, maintenance, utilities, repairs, TIMR. You can do all of that with investment property and you can't with a primary residence. So if I'm paying a property manager 6, 7, 8% to manage the property, I can write that off. Long-term rental. If it's a short-term rental, I might be paying 15, 25, 35% to have somebody manage that short-term rental for me. So there's so many write-offs. So those are really the 4 key things, the 4 benefits of investing in real estate.
Awesome. If someone is listening and is sitting on the fence here, what's the easiest way to start the conversation with you guys, even if they're like not ready to apply yet?
Yeah, they can go to our website, fill out a quick little form. We will give you a text, an email, and a call to discuss. If we miss you, you can click on our Chili Piper scheduling link and schedule an appointment. Whether that's just a quick 5-10 minute conversation with a couple questions, or it's a full 30-minute consultation. Obviously, those consultations are free. We don't charge for that. We're trying to build a relationship with real estate investors for life to ensure that we're their lender for life. They're our client. There's a relationship there. It's not transactional. That's not what we're looking for. We're looking to add value to you by giving you real actionable advice with real data and real calculators behind it. And then obviously, if you research us and you do any sort of research and look at our value props that we offer, look at our reviews on Yelp and Google and BBB and experience.com, look at the articles that have been written about us in Forbes and Wall Street Journal, look that we've been on Inc. 5000 5 times for helping so many customers. In our 11 years in business, we've been on Inc. 5 times, which is pretty cool. So we're just grateful to be able to help people grow their portfolios. And whether you're a first-time investor or you've been doing this forever, we can serve you. And that's what it's about. Someone told me the other day, sell is serve. show them that you are there to serve them and that you actually care and that you're going to put them in the best situation. It may or may not be conducive for them to do anything. They might be better off just staying where they're at. But when they leave us, they're going to have a good taste in their mouth, and we're going to part as friends, and at least we're going to point them in the right direction. And then you're educating, you're making sure that they're getting all the education, and then you're leading them to the right decision. And then the last one, I can't remember the other L, but that's our philosophy, is like, we're not going to hard sell you into something. We're going to make sure that we serve you, and you will be served and pointing in the right direction regardless.
Awesome. Site is griffinfunding.com. And yeah, if people have any questions or are ready to chat, head there.
Yeah, head
Awesome.
there. We're ready to serve you.
Great. Well, Bill, thank you so much for chatting today. It's been a pleasure, and we'll chat soon.
Thank you.